Hello, everyone. So welcome to the stream today. Very much excited for having you joining the stream today. We are continuing with our discussion on taxation or advanced taxation or principle of taxation or taxation lectures. And we are looking at corporate tax liabilities or income tax liabilities of corporations. And we discussing the issue in relation to how we can determine the tax liabilities of companies. And yesterday we started with a discussion. We looked at a couple of principles and concepts that you must understand when it comes to taxation in relation to that. So we are continuing with that. For those of you, you can comment below with any of your questions in the chat box. I'll be very much excited to answer all of your questions for you in relation to that. So you put your questions in the chat box on YouTube there or in the comment box, and I'll be answering all of your questions for you. Hi, Pani, I see you. I believe you are doing well. We are continuing with our discussion on corporate tax liabilities. So corporate tax liabilities. Let me just see this. So comment below with all of your questions, and I'll also be very much excited for you to give a thumbs up on this video. You also subscribe to the channel if you have not subscribed to the channel, and share the video as well. I'm doing a giveaway where I give people free courses on my website, full courses really on my website for them to study under my mentorship for their examination. So to qualify, you subscribe to the channel, you click on the notification bell, and then you share the video as well on social media or other platforms to be able to enable us to reach as much people as possible. That way, that is what we're going to be using in order to assist us to be able to reach people and select the people who will be enrolling in the course. So give us a thumbs up on the video and share the video as well with others so that we can reach as much people as possible. So let's see what we got. I'm going to be sharing my screen with you in a moment so we can continue with our discussion. So comment below with any questions you have. Comment below with any questions you have. I'm going to be answering all of your questions. So let me share my screen with you guys real quick. Where am I? Can you imagine? Well, it's like my screen is missing. Okay, so I see a comment on the YouTube page. Let me look at that real quick. I'm going to be looking at that real quick in a moment. Okay, so Pani said, what are some of the tax benefits for corporates? Okay, so Pani says, what are some of the tax benefits for companies? We will look at some of these things in a moment, but there are tax incentives based on the location of the business that they are in. We will get into some of these things later on today, but one thing you must understand is that, for instance, the location of the business, there can be some incentive. So Accra and Tema, 25% tax rate. Regional capitals, other regional capitals, 18.75, and then other district capitals we're going to be 12.5 in relation to that. Also, these are forms of tax benefits in that case. Then there are some industries also when you are located in, you are giving tax holidays as well to as an organization in relation to that. So we will get into some of these things. Hi, Ebenezer Atta. I see you as well. Welcome to the stream. So make sure you give us a thumbs up on the video and you comment below with any questions that you have. Give us a thumbs up and share the video. Let's reach as much people watching the stream as possible to be able to get the message across and help a lot of students across. All right, so take time to share the video and invite your colleagues to join the stream so that we will be able to take this to the next level in relation to that. So Pani, I'll be looking at some of the incentive in a moment as we get into our discussion. So yesterday, just a quick recap of what we did yesterday. Yesterday, we started with the issue in relation to corporate tax liabilities. And remember, like I said, let me show you this. So this is my advanced taxation book. This is my advanced taxation book, and that is the content that I'm using in throughout this series. For those of you who also watched the withholding tax yesterday on Facebook, I'll be doing the part 2 today, 6 p.m. on Facebook. All come from my advanced taxation book. So that is the material that I'm using here in relation to that. So you comment below with any questions you have, and I'm going to be looking at all your questions for you. Just want to make sure that set this up here. Okay. All right. So yesterday we started with the issue about corporate tax liabilities, and we saw the issue in relation to basis period. And we discussed various other matters that we need to look out for. We said that for the basis period, yes, Ghana, our year is from January to December every year. That is what we do in relation to that. But when it comes to companies, their financial year or their accounting year becomes their basis period in relation to that. So I see another comment from Pani. Pani said, how can a company legally pay less tax? All right, so Pani, a company can, Samuel Quasin, hey Samuel, it's been a long time. Where have you been? It's been a very, very long time since we met on the stream, or since I heard from you on the stream. I believe you are doing well and you are still preparing for your examination. It's been a while, Samuel. I believe you are doing well. Let me know in the chat box. So Pan Willie said, how can a company legally pay less tax? Now, a company can legally pay less tax through what is referred to as what? Tax planning. So that is also a topic that maybe we have to look out for. That's really in advanced taxation. And so I don't know if you would want me to cover that as well in much detail. We will look at it. Michelle Ingirazi. Yeah, hello. Michelle Ingirazi. I think it's been a while. Is this the first time you're joining? This is not the first time I'm hearing this name. So it's been a while since I heard from you as well. I believe you guys are doing well. Thank God all the old customers and all of the old fans are coming out today. Samuel Ingirazi, very much excited. Ebenezer is on, Pawili too. It's on in relation to that. So hey, give us a thumbs up on this video. If you're watching, just give us a thumbs up. Click on the thumbs up video. That way we get more engagement on the video, and YouTube will be able to push the video to reach as much people as possible. So everybody give me thumbs up on the video, give me thumbs up, and then if it is possible, you share it as well on social media so we reach as much people as possible. So Pawili, a company can legally pay less tax. That is called tax avoidance. So there are two things when it comes to tax planning. We have tax evasion and then tax avoidance. Now, tax evasion is illegal. If you are caught, you are arrested, or the Commissioner General finds out, definitely you're going to be paying penalty fines, and you're going to be jailed in relation to that. It can all even affect the reputation of the organization. So tax evasion is not a good thing. If you're in Ghana, you remember that there were some times around last year where the Ghana Revenue Authority was going around and was locking a couple of hotels and places of businesses because they hadn't paid their taxes in relation to that. So tax evasion is illegal, but tax avoidance, it's legal. So your question is, how can a company pay less tax legally? That is tax avoidance. And there are various ways through which companies can pay tax, less tax, really. Number one, we can talk about the type of organization that they establish. So if you want to pay less tax, it depends on the type of organization that you are establishing. Is it a manufacturing company? Is it a company located, a manufacturing company for export? Are you dealing with exports of non-traditional products? So depending on the type of business that you are in, that will affect you in relation to that. Then also location, like I mentioned this earlier, if you don't want to pay a lot of tax, then maybe you can establish your business in a regional capital, in a district capital somewhere. There, the tax rate is 12.5% in relation to that. So you realize that the tax rate will be low, unlike when you are establishing the company in Ghana here. So your question, like I said, is really a broad question on tax planning. And let me know in the chat box if it is a topic you guys will want me to cover. That is, those of you doing advanced taxation, you want me to cover on the channel, why not? I'll be covering that in detail for you guys in relation to that. All right, so Samuel Quason said, yeah, I'm really doing well, thanks for always coming away with great stuff, appreciation. All right, Quason, that's a pleasure. Then I see Patrick Queening. Hello, sir, this is my first time watching you live. I'm excited about what you are doing to help us. Wow, that is great, Patrick Queening. Thank you for joining the live stream. I believe that you are getting more value. This is why we created this channel, to be able to provide you with content on various subjects, on various topics. My objective for you is to be able to go to the exam hall and murder the exams, kill the exam, write the exams, come out with a smile, and your results come and you have passed and you'll be able to take your life to the next level. That is my objective. All right, so just give me thumbs up on the video, make it more engaging, and then let's get to as much people as possible in relation to that. Right, so let's get into the discussion. If you have any questions, you know what to do. Put it in the chat box. I'm reading all your comments. They are all popping up here on another screen in front of me, and I'll be reading all your comments and I'll be replying. So whatever questions you have, even if it doesn't relate to taxation or what I'm teaching, you can bring it up and I will address it for you in relation to that. Then remember also to join me this evening at 6 p.m. on Facebook Live. I will also be teaching withholding tax administration. We started yesterday, and I'll be doing part 2 of withholding tax administration as well today on Facebook Live. So make sure that you take time, for those of you doing tax, to join me as well there, and I'll be answering all of your questions for you. Right, so let's get into it. So yesterday we started with the corporate tax liabilities, and I made mention of the fact that in this discussion, we are trying to answer a couple of questions, such as how do we determine the tax liabilities of companies? How do we determine the tax liabilities of companies? How do we determine this allowable deduction and non-allowable deduction? The concept about capital allowance. Remember I told you that I've already covered, I did a 4-part or so on capital allowance. So if you have not watched that video yet, the link will be in the description, and you can look at a video on capital allowance, because if you are doing principle of taxation or you are doing corporate tax, one of the key issues is the capital allowance, because you know the tax authority will not be allowing for depreciation. The tax authority would disallow depreciation, but rather will give you capital allowance. So you have to understand how we can compute capital allowance from various angles, from various issues in relation to that. So we started with the basis period. We went into the fact that the financial statements of a company would have to be adjusted for tax purposes. Why did we have to adjust this? We made mention of the fact that some taxpayers or companies may try to suppress their income so that they can pay less tax. So in order to avoid that, we need to adjust their financial statements. Then we said also that there could be some errors in the financial statement, genuine errors, of which they may not be aware of. So when the Commissioner General and the Tax Authority comes to adjust the financial statement, boom, we will be able to bring it in line with the tax laws, and the right amount of tax will be paid. Then we also said that the Commissioner General want to ensure that the accounts prepared or the corporate tax returns that has been filed by the entity actually represent the whole entity and not just some transaction of the entity in relation to that. Then we said that we also have to adjust the accounting profit or the financial statement of the company so that we can bring it in line with the tax laws in relation to that. So that was one key thing that we established there. And we spoke about the objectives of examining the accounts. Then we spoke about the issue in relation to dealing with the trading various receipts that we are going to be having. And we distinguish between trading receipts and then non-trading receipts, or capital receipts and then revenue receipts in relation to that. And so we discussed all these issues there in that case. Then we concluded on the fact that when it comes to deductions that are allowable or non-allowable for tax purposes, organizations or the tax authority looks at the three criteria. Expenses that are allowable for tax purposes will include issues such as it has to be a revenue expenditure. So a capital expenditure will not be allowed for tax purposes. Instead, it will be capitalized and a capital allowance will be claimed on it in relation to that. But a revenue item will be allowed for tax purposes. Then we said that to be allowed as a deduction, the expenditure must be incurred wholly, exclusively, and necessarily in the production of the goods and services. What it means is that the expenses should not be like we pay 10,000 Ghana cedis and part is for the company, part is for the MD's private residence. It should be wholly for the company, exclusively, necessarily, meaning that without that expenditure, the business cannot go on. Now, if with that expenditure, the business can go on. Without the expenditure, the business can still go on. Then that expenditure will be disallowed for tax purposes because it is not necessarily for the operations of the business. But like I gave you an example that there is a debate around what it's necessary, what is wholly, and what is what exclusive in relation to that, because at one point somebody will say, okay, the issue in relation, okay, I'll get to that in a moment. Then the final one is that there are some deductions or there are some items that are allowable by law. And so since they are allowable by law, we don't talk about them in relation to that. Then deductions not allowed, and we broke it down to domestic issues and private issues in that case. So today we want to continue with our discussion and look at allowable and non-allowable expenses. Allowable and non-allowable expenses. Now, indirectly, remember what I told you yesterday. What we're trying to do here is to establish the tax principles. Okay, we are establishing the core principles that underline how these various treatments will be done. So let's see if I can zoom out a little bit for you guys to see me, to see our content well. So we are establishing the tax laws or the tax principles here. That is what we're trying to do here. So if we are establishing the tax principles, the question is, what expenses item will be allowable and which one will not be allowable? And that's what we want to look out for here. So setting specific allowance and allowable and disallowable expenses will now be considered. So number one, cost of traveling between residence and place of work. So let me put the question back to you. Cost of traveling between residence and place of work, should it be allowed or not allowed? Now, this is what the Act says. The Act states that the cost of traveling between residence and place of work is not an allowable expenses as it constitutes domestic or private outgoing expenses. This is because even though a man is obliged to go to work and therefore has to travel from home to his workplace, he does not actually start work until he gets to his office. So cost of traveling between residence and place of work is not allowable for tax purposes. But remember what I told you yesterday, because this thing is actually under debate, because some medical doctors and some employees say that they actually start working from their home. So they will say, okay, by virtue of technology, maybe there is a surgical operation. And so the nurse has called him and he's with his tablet and he's giving directives. So he has already started working in his home. So as far as he's working in his home, that means that his travel cost should be what? An allowable deduction in relation to that. So this one, that is traveling from place to work, if it is justified, the act says it's not allowable. But if we can establish the fact that yes, the person actually starts working from home, especially with this coronavirus issues, then many people will start working from home and that kind of thing. In that case, you are not paying expenses. But if you are working from home because you have the technology, you have already started working from home, then certainly the cost you incur because you are working, and as you're in the trotro or you are in your taxi or you're in your Uber, you are already working. That means the cost you incur for the taxi, for the trotro, for the Uber will be an allowable deduction in relation to that. So that is the extension that I put there. In this age of modern technology, where cellular phones, video conferences are widely used, it is possible to argue that business commences in homes other than and other places other than the office or workplace. I hope you get a concept. So because of technology, we can argue and say that we actually start working from home and not when we get to the office in relation to that. So that is the first item you must understand when it comes to expenses allowable or non-allowable. So cost between workplace and residence, do we allow it? No, it is not allowable. But like I said, if it can be established that the person is working from home or person started working from home, then that expenses will be allowable. If not, then it will be disallowed in relation to that. If you are watching, you have any questions, please put it in the chat box. I have another screen that is popping up your comments here in the chat box. And so you comment below with all of your questions as well in relation to that. Number 2, capital expenditure. I believe we've already said this. Now, the Act states that expenses of capital nature should not be allowed. Simple. So all expenses of capital nature, the Act says that what? It should not be allowed. It should not be allowed. Why? Because with a capital nature, it means that we will rather capitalize it and then we will claim what? How do we call it? Capital allowance on it. We'll claim capital allowance on it. So that is the issue in relation to that. Next one, repairs. Repairs. Okay, I see a comment from Pa Willie. Pa Willie said, how can you make not allowable deduction, allowable deduction? Pa Willie, I don't get your question. Can you rephrase it? How can you make not allowable deduction, allowable deduction? Okay, or are you asking how can a deduction that is not allowable, how can you make it allowable? Once the Act says it's not allowable, unless you are in an exception or you write to the Commissioner General and you are treated separately, then something that is not allowable could be allowable exclusively because of the type of organization that you are or the type of business that you are in. So if I get your question right, how can you make not allowable deductions allowable? Yeah, so that is what I'm saying in relation to that. Unless you write to the Commissioner General and request that, yes, this expense is not allowable, but because of A, B, and C, you think that you should be allowed that expenses. And if it is understood by the Commissioner General, then that non-allowable deduction could be allowable. And there are some times where entities are allowed some deductions that other entities are not allowed those deductions because of the nature of their businesses, because of the industry that they are in. So the how depends on whether you write to the Commissioner General and the Commissioner General gives you a go ahead, or whether based on the contract you have with the government or with the revenue authority that your entity should be treated separately, then non-allowable deductions can become allowable deductions. Then next one, repairs. The Act allows expenses on repairs of any plant, machinery, and fixtures used in the production of the income. At the same time, it also disallows expenses of a capital nature. So when it comes to treatment of repairs, it's like for like. Now, let me explain this in relation to that. Repair can be of a capital nature or of revenue nature. So for instance, if we have cracks on the wall, all right, we have cracks on the wall and we are mending the cracks on the wall, that's a repair to the wall, but that will just be written off because it's allowable for tax purposes. However, if maybe it's a wall, just a cement wall, and now we are putting tiles on the wall, or we are putting luxurious, expensive Italian stone or bricks on the wall, that is improvement, and so that will have to be capitalized, and we take capital allowance in relation to that. But generally, this is a principle you have to understand, and I explained this principle as well in the series that I asked you to go and watch on capital allowance. Now, when it comes to repair and improvement, the principle is that repairs and improvements allowable should not exceed 5% of the written down value of the asset. And I want you to make sure you get this very well. The repair and improvement that is allowable for tax purposes should not exceed 5% of the written down value of the asset. So let me give you an example. So let's say that for the year of assessment, it is 2008. It is 2019. And so let's say the written down value brought forward of the asset is 12,000 Ghana cedis. And so for that year, you charge capital allowance. Maybe let's say it's a class 5 asset, so it's a straight line method. You charge capital allowance of say 2,000. So the written down value of the asset is going to be now 10,000. Now let's say the repairs that you have incurred is let's say 5,000 during the year. Okay, 5,000 during the year. Now, so if you take 5% of 10,000, that is going to be more or less like what? 500. So you realize that even though the repair and improvement is 3,000, I hope I said 3,000, 3,000, we cannot allow all, rather we will allow up to only 5% of the written down value of the asset, and the balance will be added back to the opening written down value of the asset, and now capital allowance will be granted on the asset in relation to that. So that is how we deal with the repairs and improvement generally for the organization. If you have any questions, please put it in the comment box, put it in the chat box, because I want to hear from you in relation to that. Next one, asset brought in defective condition. Expenditure on repairs must be current. It should relate to the profit for the year in question. If the repairs are accumulated, it may not be allowed in relation to that. So the company brought in an asset in a defective condition and they are improving upon the asset. If the improvement is of a capital nature, then certainly it will be what? Disallowed. But if it is of a revenue nature, then no P, it will be allowed in relation to that. So that is the issue about the assets in that case. But there are certain things that you need to understand when it comes to repairs, to be specific. There are certain things you have to understand when it comes to the treatment of repairs. Repairs carried out under the following conditions are treated as capital expenses. Repairs carried out under the following conditions are treated as capital expenses. 1, the asset was not in a fit state for use in the trade until repair had been carried out, or could not continue to use in the trade without being repaired shortly after the acquisition. So we bought an asset in a defective condition. Listen carefully. We bought an asset in a defective condition. Now, if the asset was not fit for use and it required repairs before we can use it, then that repair will be called a capital expense. But if it is working and we are just repairing it, then that will be a revenue expense and so will be allowed for tax purposes. I believe you are getting the principle very well. Next one. There is evidence in, for example, the contract for the sale of the asset or in negotiation leading up to the contract or in surrounding circumstances that the purchase price was substantially reduced because of the dilapidated state of the asset. So the second scenario is that, okay, we bought the asset. So for instance, we should have paid, say, 10,000 Ghana cedis for the asset. But because of the dilapidated state of the asset, in the negotiation or in the contract, the supplier or the seller said, oh, okay, buy it for 6,500 so that you can add some money and repair it and start using it. In that case, it means that whatever amount we spend on that asset which has been bought at undervalued price will be treated as what? A capital expenses, and we will add it to the cost of the asset, and then certainly capital allowance will be claimed on it in relation to that. So that is the thing about dealing with repairs in that case. The next item. So if you're watching, thank you for joining the broadcast. Thank you for watching it. Very much excited to have you every single day, 4:30 p.m. live on YouTube here. I'll be lecturing, and then 6 p.m. I'll be live on Facebook as well, and we'll also be lecturing to answer your questions for you. I'm doing this every single day during this period of school closure and school close down so that you can be able to still study and prepare well for your examination, and most importantly, pass your examination. So keep on and give us a thumbs up on this video. Consider to share the video as well. If you have not subscribed to the channel also, consider to subscribe to the channel so that we will be able to reach as much people as possible, because as we get more engagement on the channel, that is how YouTube is able to push the videos, push the content out to reach a lot of people, so we can assist a lot of people together, because you are not the only person who is in need. We are all in need in relation to that. So thank you. Give me thumbs up on the video, subscribe to the channel, and share the video as well. So I see a question from Samuel Karikari. Can you please give another scenario on repairs to understand it better? I mean the scenario about 85%. What are some of the tax benefits in real estate and gas industry? Okay, so let me answer Samuel Karikari's question first. Can you please give another scenario on repairs to understand it better? Okay, so this is what I mean. Let's say that for the year 2019 beginning, written down value brought forward of the asset, it's say 10,000 Ghana cedis. Then on that particular asset, what happens is that we did a repair or improvement on that asset. So let's say that the cost of the repair or the expenses of the repair we incurred was say 1,500 Ghana cedis. 1,500 Ghana cedis. Now, the written down brought forward of the asset is 10,000. So we will calculate the capital allowance for that period, and let's say it is 2,000. So when we less it from the 10,000, we're going to get 8,000 Ghana cedis. So that is the written down value of the asset at the end of the year. Now, the improvements or repairs allowable for tax purposes should not exceed 5% of the 8,000. So when we take 5% of the 8,000, that is going to be somewhere like what? 200. Am I right? 10% of 8,000 is 800. So 5% of 8,000 will be 400. So it means that even though we've incurred repair and improvement 1,500 Ghana cedis, we can only allow 400. So 400 will be allowed as an allowable deduction, and the 1,100 left will be added back to the opening balance of the asset, which is 10,000. Then we will now determine the capital allowance for that year, and then we'll get a written down value of the assets. I hope you get it now. Samuel Karikari, let me know if you get the concept now in relation to that. Then I see another, so what are some of the tax benefits in real estate and gas industry? Okay, so this one is industry specific. If I say I can come up with this offhand now, I will not be able to provide you with an accurate answer, because real estate and the petroleum, petroleum, I could talk about petroleum, mineral resources. Okay, Samuel Karikari said, thank you, you are welcome. But real estate, what happens is that there are a couple of requirements that you have to meet. You have to be registered with various governmental institutions, and you can actually request that, okay, I'm using a sustainable material, environmentally friendly material to build my houses, or I am building the houses to sell it at a lower price. I'm not going to be making much profit. So these two industries, their benefits are specific based on the negotiation that goes on between the government of Ghana and the developers or the investors or the contractors in these two industries specifically. Because there are times when there are no specific rules there, but when you raise these concerns or you go to the government with these concerns, they look at it and then they will give you an incentive that will help you, especially if you buy into the dream or the goals of the company in relation to that. I think my light just went off, but we can continue. Then Ebenezer said, can the government of Ghana, no, can the CG in his own, Commissioner General in his own wisdom make an unallowable expenses allowable without Parliament or ministers approval? Yes, that is possible. That is possible. But like I said, if the thing is unallowable by law, there is no way it will be allowable. It means that in order to make it allowable, you would have to write to another authority, maybe the Ministry of Finance, maybe the Ministry of Trade and Industry, because these regulatory bodies are in conjunction and they work together with the Ghana Revenue Authority. So certainly once the thing is unallowable, the Commissioner General cannot just say it's now allowable. He must also communicate whatever request you make with the Minister of Finance and the other regulatory bodies to come to conclusion on what must be done in relation to the request that has been made. So Ebenezer, that is judgmental. It is not a straightforward thing in relation to that. Okay, so whatever question, put it in the comment box in relation to that. Okay, so let's go. The next item that we want to look at is infraction of the law. Now, I mentioned this yesterday. Infraction of the law simply means that you break the law. So if you break the law, can the government allow, or can the expenses you pay be allowable for tax purposes? The answer is no. So for instance, in our factory, we did not meet the hygiene and safety requirements by the regulatory authority, and so we were fined 10,000 Ghana cedis. If we pay that 10,000 Ghana cedis, will it be allowed for tax as an expenses for tax purposes? The answer is no. It will not be allowed as an expenses for what? Tax purposes. Why? Because when you breach laws and you pay fines or any fees resulting from that contravention of the law, it will not be allowable for tax purposes. So anytime the company does something illegal or the company breaks law, then any expenses we pay will not be allowed for tax purposes. Or our driver, maybe our van, delivery van, crossed the red light and was arrested by the police, and there was a fine, spot fine of say 5,000 Ghana cedis, and we paid that 5,000 Ghana cedis. For tax purposes, we will not be allowed that kind of deduction, because crossing the red light is actually an infraction of the law or a breach of the law. Hence, that expenses will not be allowable. Next, defalcation. This is a very, very important aspect of tax. It's about embezzlement or misappropriation of funds. Now, the rule states that when it relates to a junior staff, it will be allowable for tax purposes. It will be treated as a business loss. But if it is a senior staff of the organization, then it will not be allowable for tax purposes. So maybe the CEO misappropriated a fund, or the CEO embezzled a fund, or the CFO of the company embezzled a fund, and the company said, oh, they've written it off. Yeah, in the financial statement, they can write it off. But when the Commissioner General come or the tax authority come, they will add it back to the profit in relation to that. But if it is a junior staff, then that one can be allowable or can be treated as a business loss in relation to that. Next one, insurance recoveries. Insurance recoveries. Expenditure on insurance of business assets is an allowable deduction for tax purposes. However, the Act also prohibits the deduction of any sum recovered under insurance or contract of indemnity. The prohibition means where revenue expenditure which would be otherwise allowable is claimable from an insurance company, the government, or some other authorities. So this is what you got to understand. So once you are insuring an asset, insuring your business or whatever form of insurance you are making, that expenses on the insurance is allowable for what? Tax purposes. That expenses is allowable for tax purposes. But if it is money that you are putting aside and the amount is recoverable, then the allowance or the allowability of that expenses will be disallowed by the tax authority. So let me give an example of that. Where there is a damage by fire to a business premises, the cost of repairing and making good the damage will be treated as an allowable deduction. So there is a fire outbreak and our factory is part of our business is what? Destroyed or damaged. If we repair it, the cost of repairing it will be allowable for tax deduction or for tax purposes. Nemo, if the trader has an insurance policy which entitles the business to claim on the insurance company for the expenditure, the cost of the expenditure will be disallowed. I hope you get a concept. So if we have insured the business, that means the repairing cost, we are not the ones supposed to be paying it because the insurance company will cover that cost. For that reason, the cost we will incur in what? Repairing will not be allowed for tax purposes in relation to that. So that is the issue about dealing with insurance recoveries. Now we move on to the next item, income tax, profits tax, etc. Now remember I spoke to you about income tax, profit tax, among others as well yesterday. Now the Act prohibits the deduction of any income tax, profit tax, and other taxes. These charges are imposed on gains and profits arising from trade businesses and vocations. They are paid after the profits have been made and therefore cannot be properly charges to the account. So you cannot deduct any tax. So that is why when we look at the financial statement of the company, maybe they will say, you know, companies pay taxes in installments. Some companies pay taxes in installment. So as part of the financial statement for the year ended, they will say income tax paid maybe 3,000. That tax they have paid is not an allowable deduction. So we will add that whatever tax that has been paid in the year back to the profit. Then when we get their chargeable income, we will now calculate their tax liability, whether we use 25%, whether we use 18.75%, whether we use 12.5%, or whatever percent that it is we have to use. When we use that percent and get their tax liabilities, then we will now deduct the tax they have paid during the year from that figure. What will be left will be the amount of tax outstanding for the year ended under consideration. I believe you get a treatment. So whatever tax that has been paid during the year, we add it back to the profit. And then when we determine the tax liabilities of the company, what do? We now add, subtract the tax that has been paid earlier from the total tax liabilities for the year. And that will give us the answer that we need in relation to that. Next one, exchange losses. Exchange losses. Now, you know, companies involved in foreign exchange or international trade and all of that. So if the company is involved in any of those things, and like the way coronavirus has made Ghana cedi very beautiful like that, you know, the Ghana cedi is actually getting out of hand a little bit in relation to that. And so companies are going to be incurring some exchange losses. Is it allowable or not allowable? The tax law says that it is allowable as far as it is of a revenue nature. So let me explain this to you real quick. Foreign exchange currency losses incurred by a person in the course of business is an allowable deduction, provided the loss is not a capital nature. Provided the loss is not a capital nature. So the forex exchange currency loss should be in respect of any debt claim, debt obligation, or foreign currency holdings of that person. So that is a very important thing in relation to that. So maybe we are repaying our debt, we are repaying interest, and that is what is resulting into the forex exchange loss in relation to that. Then bad debt. Do we allow bad debt? Bad debt is not allowable for tax purposes. it is only allowable for tax purposes if the entity has made all efforts to recover the debt, but it's unfruitful, then it will be allowable for tax purposes. So if you sit down and say, oh, we've written off bad debt, the tax authority will come and say, they will add it back to the profit. Why? Because you should have taken an action, you should have made some efforts in arriving, or you should have made some efforts to try to get the money, and you did not get it. For that reason, yes, it will be allowable as a deduction in relation to that. So let's look at it. A debt claim that has become bad is an allowable deduction, provided it was included in the income of the person in the prior basis period. Two, the debt claim should also be in respect of the normal cost of the operation of the business and not of a capital nature. It should be noted that a bad debt has been defined in the Act as a debt claim of a person in respect of which that person has taken all reasonable steps. The key thing I want you to get about bad debt is that statement right there. That statement right there. That's the person, let me underline that for you because I want you to really, really get that. The person has taken all reasonable steps to pursue the payment in which that person reasonably believed will not be satisfied. So not that you just get up and say, oh, it's bad debt. No, you have taken all reasonable steps and you still cannot get the money. So if you've taken all reasonable steps and you still cannot get the money, then legitimately it will be allowed for tax purposes. But if you have not taken any step, I'm sorry, you cannot collect it as part of your bad debt in relation to that. So that's what you have to understand when we come to the issue about bad debt. Let me take out this red bar here. Okay. So let's go. Next one. Interest charges disallowed. Interest charges disallowed. Now, so this is where the issue about thin capitalization comes to play. Now, the tax law says that interest charges allowable for tax purposes. We're going to be using what? The thin capitalization concept. And the thin capitalization concept is 3:1. 3. So it has to be what? 3:1. Okay. Not 2:1 as you see here. It's 3:1. That is the thin capitalization concept. Now, what does it mean when we say interest charges allowable should be 3:1? What it means is that, you see, you know, from financial management, we follow the pecking order theory. When a company is looking for funding, what does the company do? It goes to its retained earnings first, then it goes to debt capital second, then it goes where? To equity. Now, why is debt prioritized over equity? Because we say that debt is tax deductible. Now, the fact that debt is tax deductible does not mean you can take on huge debts. So for tax purposes, the tax law says that the debt that will be allowable for tax purposes should be a maximum of 3 times the equity of the company. 3 times the equity of the company. So for instance, if the company has a debt stock of say $20,000, I want you to listen to this carefully, 20,000 Ghana cedis, and then that is the debt, 20,000 Ghana cedis, and its equity that it has, it's say 5,000 Ghana cedis. So the debt is 20,000 Ghana cedis, equity is 5,000 Ghana cedis. So the total capital employed is going to be 25,000 Ghana cedis. And on the 20,000 Ghana cedis debt, let's say the company incurs an interest of say $3,000 or 3,000 Ghana cedis. Can we allow all the 3,000 Ghana cedis as allowable deduction? The answer is no. Because when we go with the pecking order theory, its equity is $5,000. So 5,000 times 3, 5,000 times 3 will be what? 15,000. Now forgive me with the currency, okay? I'm doing tax, so I'm just trying to do the Ghana cedis. So 5,000 times 3 will be 15,000. So even though the debt stock is 20,000, we will only allow interest on what? 15,000. So of the debt, of the interest expenses of 3,000, we cannot allow all. So how do we get the allowable interest? It will be the 15,000, which is the 5,000 by 3, divided by the 20,000, which is the total debt stock, times the 3,000, which is the interest we pay. The figure we get is the allowable interest expenses. Then we subtract that from the 3,000, and the balance will be non-allowable what? Interest expenses in relation to that. And the issue about thin capitalization, I don't think I have it on my YouTube channel. I think that is on our study portal online. I don't think we have it on the channel here, but let me know. Maybe I can teach it as well as we go ahead with our discussions in relation to that. So these are what you have to understand in relation to the various expenditure items and whether they are allowable or they are non-allowable. So that is it about that. So we've discussed some issues here. Cost of traveling between residence and home. We said it's disallowed, but we said if the person or the entity can prove that, hey, work actually start from home, then it will be allowed. Capital expenditure, we said it is disallowed because it is added to the cost of the asset and we claim capital allowance. Repairs, we said that the allowance is what, 5% of the written down value of the assets in relation to that, then the repair has to be a revenue repair in relation to that. If the company brought in an asset in a defective condition, the repairs they make on it, we look at two criteria that if the asset wasn't fit for use and they repair it, then that amount they pay would have to be capitalized. So we don't allow it for tax purposes. Then infraction of the law, if you break the law, whatever expenses you pay in terms of fines and fees will not be allowed for tax purposes. Embezzlement of fund or misappropriation of fund by junior staff will be allowed, by senior staff will be disallowed. Insurance recoveries, what we mentioned here is that the payment that we are making for the insurance will be allowed for tax purposes. However, if the event actually happens and we are incurring a cost in repairing the damage, it will be allowed for tax purposes. However, if there is an insurance cover for that particular damage, then the cost we will incur on the repair will not be allowed for tax purposes because we would be reimbursed by the tax authority with the indemnity under the insurance policy. Then we said any income tax or profit tax paid already by the company is also disallowed because of the fact that that is not a payment that they are supposed to make yet. So we add it back to their profit. And after we get their corporate tax liabilities, we deduct the tax they paid already, they will be able to get the outstanding amount in relation to that. Then we said exchange losses also are allowable for tax purposes as far as they are of a revenue nature and they relates to debt claims, debt obligation, or foreign currency holdings in relation to that. Then bad debt, we said yes, bad debt is not allowable for tax purposes, but will be allowable for tax purposes if and only if the entity has taken all reasonable steps to pursue the payment, but has been unsatisfied or has not been able to look at that. Then for interest charges, we said we use the concept of thin capitalization 3:1 to decide how much we would have to look out for in relation to that. So these are the things you must understand about the various expenditure items. If you have any questions, put it in the comment box, put it in the chat box. I would want to hear from you in relation to that. Now, the final thing about dealing with a deduction is to boil down all the principles. Now, maybe there could be an item in the question that I haven't covered here. All right, there could be an item in the question that I haven't covered here, and we have not covered. But if you see it in the question, what do you do? So these are the deduction principles that you must understand. If you forget anything at all, these deduction principles are critical, and you've got to make sure that you understand them very, very well. So from the above, the following basic principles may be adopted as a test in deciding whether an item is deductible or not. So this is a test you will do when you are dealing with deciding whether the item will be allowable or not allowable. So this is very, very important that you must understand this concept here. Very, very important. So let's look at it. Number one, is the expenditure wholly, exclusively, and necessarily incurred in the production of the income? If the answer is yes, then you allow. If the answer is no, then you disallow it. I'll be getting it. Number two, is it specifically allowed? Does the law allow that kind of expenses you're talking about here? If yes, you allow it. If no, you disallow it. Is it specifically prohibited by the law? If it is specifically prohibited by the law, like infraction of the law, for instance, then you also don't allow it. Is it a capital or a revenue expenditure? Remember, if it is a capital expenditure, it is disallowed, added to the asset, and capital allowance will be created, computed on that. But if it's a revenue expenditure, it is allowed in relation to that. Then the last thing is it a proper deduction on accounting principle? So is it a deduction that we would do in accounting concepts or in line with the tax laws? So that is also the question we ask. So this is a test we carry out when we are asking whether an expenses is allowable or non-allowable in relation to that. So any questions, please? Any questions? Comment below in the chat box with all of your questions in relation to that. So comment below with all of your questions. If you have any questions for me before I switch over to the next slide. Okay, so my light is back. So let's look at some other basic principles in relation to that, some other basic principles. Now, I've given you already some of the tax rates in relation to that, but one rule of thumb that you must understand when it comes to computation of the tax liabilities is that you must consider, number one, a couple of things. So look at what I have there. Corporate tax liabilities, basic principles. Income, wow, what's going on? Okay, income tax liabilities, basic principles. Income tax rates applicable to companies differ according to the industry, the location, and even what? The type of the business that they are in. So remember, if you are computing the tax liabilities of a company, don't just jump and use any rate. You must ask yourself, what industry are they in? Where are they located? What type of business are they doing? So companies in general, 25%. Okay? Companies engaged in mining and upstream petroleum businesses, 35%. Then there are the location rate. Regional capital, 18.75. District capital, 12.25. Okay? All these things are rates that you have to take into consideration. Companies that are in the free zone, their tax is different. Companies that are for exports, their taxations are different. So you must understand all of these in relation to that. Then okay, so I see a question from Miles Led. Sometimes I see specific bad debts being allowed. Why is it allowed since no further details are usually provided? Sometimes I see specific bad debts being allowed. Now, if they use the word specific bad debt, that means that, so I like your question, Miles. That's an excellent question. So I should have spoken about this. Usually in the question, there are two things you must understand. It could be general bad debts or specific bad debts. So if it is general bad debts, then the company hasn't taken any effort. So that will be disallowed. But if it's a specific bad debt, it will be allowed. Why? Because specific means for that particular debt, the entity has made some effort. The entity has reasonably taken certain actions to get the money, but has not been able to get the money in relation to that. So Miles, the reason why it is allowed without a further explanation is that once it is specific bad debt, it should be allowed. But if it's a general bad debt, that one will be disallowed in relation to that. Then Ebenezer Atta said, please, will you post this slide on the WhatsApp platform? Oh, I don't think we will post this slide on the WhatsApp platform because Ebenezer, you don't have my book on tax, right? You don't have the book, you don't have this book on tax because the e-version of the book is not actually available or like that. So I'll see what we can do if it is possible to give the slide out on the platform. So Ebenezer, you can WhatsApp me after the broadcast and I'll see what we can do. So Miles, I believe your question has been answered. Any question, please put it in the comment box for me. Or the chat box, whichever way. Okay. So there are a couple of other principles quickly for me to go with you in relation to that. Okay, so Miles said, well noted. Thank you. You are welcome. Now, remember, I'll be live on Facebook as well at 6 p.m. More or less like 20 minutes from now, I'll be live again on Facebook at 6 p.m. and we'll be continuing with withholding tax administration. Yesterday, we did a part 1, and today we'll be looking at the part 2 on my Facebook page at Nhyira Premium. So for those of you who joined the stream yesterday and you are doing taxation, you can join me as well there 6 p.m. today as we continue with a discussion on withholding tax there in that case. So mineral royalty, subject to any fiscal stabilization agreement, the mineral royalty rate is 5% of the total revenue earned from minerals, excluding petroleum and water obtained from mining operations by a holder of a mining license, restricted mining licenses or small-scale mining licenses. This specifically, it's for level 3 advanced taxation students, because in level 2, natural resources, oil exploration, those things are not in level 2 principle of tax. So this advanced taxation, level 3 for the ICAG Ghana examination or the ICA Ghana exam. So there will be a tax rate on royalties, 25%. Did I say 25? 5% in relation to that. Then we have the principle of ring fencing of financial institution, petroleum and mineral properties. So the chargeable income of financial institution, petroleum and mineral operations is calculated separately for each financial service, petroleum right or mineral operations. What it means is that, for instance, if an entity has different financial services or has different petroleum rights. So for a contractor, I have different petroleum rights. I have one right in, say, one oil field here, and I have another at one oil field here. We don't say because I owe the two, let's calculate the chargeable income for all the two in one single account. No, we will treat them separately in relation to that. Again, this is typically for advanced financial management students. Then dividends. Remember, I've told you this about dividend. Okay, I actually spoke about it in the withholding tax administration, that dividend is subject to 8% withholding tax as far as the company owns less than 25% of the shares of the company. So once an entity or an individual owns less than 25% shares of the company, they have to withhold tax of 8% anytime dividend is paid. But if you own more than 25% of the company shares, then that this 8% dividend is not going to be paid in relation to that. And this is about withholding tax, and we'll deal with it in relation to that as well. Then the next issue is the national. Okay, so I see another question in that case. Walter Cujo said, kindly explain the difference between domestic expenditure and excluded expenditure with examples. Did you say excluded or external expenditure? Is it external expenditure you wanted to write? excluded expenditure. When you say excluded expenditure, what do you mean? Maybe clarify for me, Walter, could you? And I could explain that for you. Now, domestic expenditure, like we mentioned this earlier, is any expenditure that relates to private uh, uh, that relates to private individuals and does not relate to the company. So for instance, the repair of the MD's residence is a domestic expenditure. Okay, the repairs of the MD's residence is a domestic expenditure. Cost incurred in traveling from residence to work is a domestic expenditure. We cannot consider it as part of business expenditure, and so should be allowable or should be allowed for tax purposes. So that is the concept that you must understand in relation to that. Okay, just wanted better light for my background. So that's the domestic expenditure. The second one, excluded expenditure. I don't know what you meant by excluded expenditure. So maybe if you can clarify, could you? I could answer that for you much clearer. Okay. So when it comes to taxation, also remember I told you the location, the business you are in, and all of those things are important. Other rules you must understand include free zone developers or enterprises. Companies registered to operate as free zone developers or enterprises enjoy 10-year income tax holiday. Once the 10-year tax is expired, the tax rate on the export of goods and services is 15%, and another income is taxed, any other income is taxed at 25% in relation to that. So the export of goods and services, they will pay 15%. Then any other income those free zones get after they are 10 years of tax holiday is going to be 25%. Then young entrepreneurs, business income of young entrepreneurs. Now, when we say young entrepreneurs, what are we talking about? What are we talking about when we say young entrepreneurs? The business income of young entrepreneurs operating in certain industries is exempt from tax for 5 years. For 5 years. Depending on the location of the business, the tax rate is increased up to 15% for the next 5 years, and then up to 25% thereafter. Such businesses could also carry forward losses for 5 years. So young entrepreneurs should be below 28 years. If you are below 28 years and you have established business, you have 5 years tax holidays. Then after the 5 years tax holidays, depending on the location or depending on the location of the business, you may be paying 15% tax rate for the next 5 years, that is after the tax holidays. And then after that 5 years is also exhausted, you will now come to the full 25% for traditional companies in relation to that. Private universities. Private universities are exempted from taxes if 100% of the profit after tax is plowed back into the business. It's plowed back into the business. So as far as they are bringing back the profit into the business, it will be exempted from tax in relation to that. Okay, so Walter Kujo said external expenditure. So now in the context of talking about now, I think I need to get clarity on the context in which you are asking this question. Because if you say domestic and external, what do we mean? Like what we were speaking about here about domestic expenditure, what did we meant was the issue in relation to companies, okay? And then doing something that is of private nature and that is not of the business. So if you say external expenditure, because remember, if the MD travels to Dubai for a business meeting in Dubai, that is an allowable expenses, okay? But if the MD says that he needs his wife to be there before he will be able to get morale to work, the cost we incur on the wife's presence there is an allowable deduction, is not an allowable deduction, because the wife is not going to work for the company. And if you say you need your wife before you can work, I mean, who does that? So if you say external expenditure, I want to get a context in which you are asking the question so that I can answer you much better, Walter Kujo. So if you can clarify your question much better for me, I'll be very much excited about it. Taxation of gifts. A gift received by an entity in respect of business or an investment is included in the assessment of the income of the entity and taxed at the applicable rate. So if the business receives any gifts, it is just added to their assessable income for that year. You don't tax it differently. We just add it to their assessable income, and then we'll use the applicable rate. If it is 25%, 22%, 18.75%, 12.5%, whatever applicable rate will be used there in relation to that. How about when we sell assets or we are forgiving a liability? How do we treat that? The gains or losses from the realization of business or investment assets and liabilities are included in the assessable income of the entity and taxed at the applicable rate. So if we sell an asset and we make any gain on that, we just add it to the profits of the company, and we'll be using the applicable rate on that in relation to that. So these are a couple of principles, concepts that you must understand when it comes to taxation of companies. Any questions, please? Any questions? And I'll be concluding here on the principles. I'll be concluding here on the principles, and maybe tomorrow we will take a full question, and we will answer some of the issues in relation to that as we continue with our discussion. So if you have any questions, please put them in the comment box, put them in the chat box, and we will I will read them out and look at it. Remember to join me as well on Facebook, 6 p.m., just a few minutes from now. I'll be teaching on withholding tax. We did the part 1 yesterday, so we'll be looking at the part 2 today in relation to that. Willie said, what are the tax benefits of home office? What are the tax benefits of home office? Willie, when you say home office, what do you mean? Tax benefits of home office. What do you mean by that? Clarify your question better for me so I can answer you well. All right, Willie. When you say home office, what do you mean? So like, for instance, clarify your question for me, Pavili. So for instance, as I am working now from home, like I work from home now and I've been working from home even before the lockdown. So for some time now, I've been working from home. Is that the context you're talking about, that the tax benefit you will get? As far as it is a registered place of business, it should be a registered place of business before. Okay, having an office at home. Is that a registered place of business? If you have an office at home that you do some work there, maybe you didn't finish the work in the office and you are doing it in your house. Yes, if you can prove to the tax authority that it is a registered home office, then they can take it in relation to that. It can be allowed. Any expenses you incurred in your home office can be allowed for tax purposes, but technically it may not be possible, because if you say home office, like with technology now, people are working from home. Like the way I am having this stream with you, if not for coronavirus and closure of schools, I will be lecturing in class. But since school of closure, everything now I do it from my home, and I have my home studio here that I do everything. We shoot videos and we create content here for our YouTube channel and for our online study portal as well. Now, that doesn't mean that we can claim tax deduction for this period, because so it depends. It depends. If the company or the entity can actually validate that it is a registered home office of the business and that really the person works from home, then there could be some tax incentives on electricity bill and those things in relation to that. Otherwise, we will treat it as a domestic expenditure and will be disallowed. Nhyira, what are the key topics to focus on with respect to advanced taxation? Okay, so Miles said, what are the key topics to focus on in respect to advanced taxation? All right, Miles, when it comes to advanced taxation, there are actually key issues you have to look out for in relation to that. Okay, so let me answer Miles' question, then I can come to the rest of you guys, your questions in that case. So let's go. Now, in advanced taxation, one thing you must understand is that the examiner is going to be bringing more principle-based questions than calculations. So you can check the November 2019 examination, and that's how the exam structure is going to be going forward. Now, so if there are three key things, there are just three key areas in advanced taxation: optimal tax planning, corporate tax liabilities, as well as communication, I think so in that case. So if you talk about key areas you have to focus on, number one, corporate tax liabilities, like the topic I just treated here, it's critical in advanced taxation. Number two, taxation of natural resources, oil, gas, petroleum, those things. It's a very, very huge area. Then tax planning is very, very critical when it comes to advanced taxation. So it is something that you have to also look out for. Tax planning, the issue about transfer pricing. Definitely, the examiner is going to throw a jab at you in relation to that. So you have to make sure you understand that principle well in that case. Then remember, there are some ethical issues as well in advanced taxation and what the tax expert or the tax consultant is required to do. So the ethical issues in taxation, you must also consider that. So like I said, the examiner is going to go and ask you about the principle. So a scenario can be pulled up. Then the issue about thin capitalization and then treatment of financial cost, financial gain. That's also very, very critical, both in principle of tax and as well as advanced taxation. The examiner will test your principles in that case. So the principle, so the examiner can give you an illustration like this and say that KK has been in the United States all this while and has decided to come to Ghana to establish a business. Advise KK the industry that, or the kind of business you will establish in order to avoid tax. You know, tax avoidance is illegal, right? Tax evasion is illegal. So in such a question, the examiner is asking you about tax planning issue. So you have to talk about the legal types of businesses that we can be established, the various tax incentive for the various industries, the various locations. So such question is broad, and the examiner wants to find out whether you really have the nuggets in relation to the tax incentive for the major industries and the major locations of the organization or of the country, sorry, in relation to that. So, Miles, that is what I would say to you in that case. Walter said no deductions are allowed for domestic or external expenditure incurred by a person in the computation of assessable income. Yes, no deductions are allowed. Kindly identify 4 items that constitute domestic expenditure. We've already mentioned some of these things that constitute domestic expenditure. We said the issue in relation to repair of the private residence is a domestic expenditure. Issues in relation to the clothing that the individual will wear will be referred to as domestic or personal expenditure. Travel cost incurred in traveling from work to the office could also be the issue in relation to domestic expenditure in that case. Then Patrick Queening said, will someone who is a young entrepreneur in tourism industry, specifically in clothing, but because of COVID-19 now producing PPEs, such as nose masks, be exempted from tax? Okay, I think I think this is a specific question on tax in relation to that. Um, I think the government has given some tax waivers for entities who have registered with the is it Food and Drug Authority, something like that. Entities who have registered to produce PPE, there are some tax waivers that are provided for them. So in case the entity is producing these PPEs and is registered and recognized, then definitely when the tax waivers come, they will be exempted from tax in relation to that. So yes, Patrick Quenin, it depends whether you are registered with the regulatory body responsible for the, I think, I've forgotten though, but I think I don't know if it's a Food and Drug Authority. I've forgotten the specific institution, but you have to be registered with them so that you are recognized by the government. In that case, when there are any tax waivers, you will be getting a portion of that to your income in relation to that. And just recently, I think yesterday or today, the Ghana Revenue Authority has released a tax amnesty, meaning that anybody that has debt outstanding up to June 2020 can pay for their tax liabilities without any penalties in relation to that. So, Patrick Quenin, that is the answer to your question. Willie said, what are the tax benefits in real estate since I'm creating jobs and providing commercial properties and doing what the government wants? Okay, so Willie, number one, you have to be registered. It's your business registered with the regulatory bodies. There are Ministry of Housing. You have to register the business with the Ministry of Housing, and there are some other government institutions that you have to register with in order for you to join to enjoy these tax waivers in relation to real estate properties in that case. So you should be registered with those government institutions responsible for regulating. And so once you are registered and you prove that, yes, you are doing A, B, and C, they will now issue directives or letters to you that will be given to the Commissioner General, and you may be exempted from tax for a number of periods in that case, as far as you are producing houses using sustainable materials, you are producing houses selling at a certain price level, and you are producing or you are constructing houses or developing properties for a certain group of people in the country. So there are categories available in relation to whether you will be exempted or not. But certainly there are exemptions available for real estate companies. But like I said, you should be registered with the required regulatory body in relation to that. So any other questions for me? All right, so I'm going to be concluding here today. And thank you very much for joining the stream. I'll be live on Facebook in the next few minutes as we continue with our discussion on withholding tax administration in Ghana. So, Pa Willie, Ebenezer Atta, Samuel Kwesin, Michelle Ingirazi, Samuel Karikari, Miles, Walter Kujo, Patrick Quenin, all of you guys, thank you very much for joining the stream, and all of you who were watching but you did not ask any questions, thank you very much for taking the time always to watch and join the stream. Please remember to subscribe to the channel if you have not subscribed to the channel, and give us a thumbs up on the video. So on the video page, you give us a thumbs up on the video, and also share it as well with others so we can reach as much people as possible, because what we're doing, it's for you guys. And so we want to reach many people who are also studying and who are also preparing for their exam. So give us a thumbs up, share the video, and subscribe to the channel. And I'll see you same time tomorrow, 4:30 p.m. as we continue with our discussion in relation to our preparation for the ICA examination. Now, for those of you also asking the issue about whether ICA has come with any date. No, currently the ICA hasn't come with any date about the exams yet, but things are, the ICA is still considering having two examination sittings this year, or having two sets of exams this year as always. So we are keeping our fingers crossed, and anything that comes up, ICA will be issuing a communique, and definitely I'll be taking my time to share that one as well with you. So thank you very much for joining the stream, and I'll see you same time tomorrow, 12 p.m. Did I say 12 p.m.? 4:30 p.m. here on YouTube, and then 6 p.m. on Facebook. So you can join me on Facebook a few minutes from now, as I'll be looking at withholding tax administration part 2 of the discussion in relation to that. So thank you very much, and you take care of yourself. Make sure you sanitize your hand. Remember, coronavirus is still here. Sanitize your hand, wash your hand under running water. Make sure you wear your face mask or nose mask or face shield, whatever you want to call it, when you go out, and make sure you keep social distancing so that you take care of yourself, because we need you. Now we have close to 3,100 cases here in Ghana, and it's rising. It's rising. So you make sure you take care of yourself as you go out there with your days and the things that you do in relation to that. So bye-bye, and I'll see you same time tomorrow. Take care.